So the sell-off in gold continues today after the metal took the largest plunge in over a decade on Friday. Daniel Ghali is Director of Commodity Strategy at TD Securities and joins us now to talk some more about this. Thanks for your time.
Yeah, thanks so much for having me.
So correction was widely expected, but why do you think gold continues to sell off today?
Yeah, well, I think anytime that prices move in a parabolic fashion, people start to expect a correction. You just never know when exactly is it going to happen. But I think on Friday, several things happened. First of which is that the president nominated the new chair to the Federal Reserve, Kevin Warsh, who has had at least a decade of a more hawkish tone to him. That certainly played a role, but the microstructure also came into effect, and most notably that some aspects of the Chinese market were closed for participation. And what that meant is that they could neither buy nor sell in a pretty crucial time for the market. Today, we're looking more at things that are more mechanical in nature, the forced selling activity that arises after one of these big declines. And in our view, we've actually probably seen the bulk of that selling activity already.
Okay, forced selling because?
Well, there's an evolution of products that track returns generated by gold and silver on a levered basis. These have to rebalance once daily and are influenced by these kinds of outsized moves in prices such that they are forced to sell or buy commensurately.
Okay, so do you think that's the kind of investor that's driving this right now?
Partly, yes. I mean, ultimately, if we zoom out, the gold trade has evolved throughout a cascade of different buyers. In 2022, it was really about central banks and the de-dollarization theme. That persisted for some time, but increasingly over the course of the end of 2024 and for most of 2025, that's mostly been about institutional participation in gold, which we now think actually is probably at an all-time high. And in the end part of 2025 to date, we actually think it's been overwhelmingly driven by retail participants, whether that be in India, in China, and in the rest of the world, who have bought truly an immense amount of precious metals bullion.
Okay, so the explanation that you've given, which is in many parts, would that also work for the other precious metals sell-off? I know silver is looked at a little bit differently.
Yeah, certainly. I think the big difference here between gold and silver is that if truly precious metals were in a bubble heading into this decline in prices, the difference is that you still have a structural demand driver with respect to gold, whereas in silver, we actually think the demand boom that catalyzed the rise in prices over the last several years to begin with is now starting to subside. And here I'm talking about the silver's use in solar cells, which we think at these prices are unsustainable. And as a result, we are retaining our cautious outlook on silver.
Okay, so a lot of people have been looking to get into silver. They're looking at the correction now and thinking maybe now is the time to get in, but you don't think so?
Well, we think a lot is going to depend on market psychology, and particularly with respect to retail participants. This truly has been the largest driver over the last 2 to 3 months. And the scale that we're talking about here is something that is unprecedented. So whether or not retail participants will see this volatility and choose to step out and onto the sidelines for a period of time is quite possible. In fact, we think that's more likely, but it's also possible that retail will see this decline in prices and find it as an opportunity to buy. Regardless, we actually think that the structural demand drivers, especially with respect to silver, are now in flux. And so we think that the retail participants now have to more than offset that decline in industrial demand.
Okay. Can you reiterate where you think gold will go this year and next?
Well, we think somewhere around current prices is closer to fair value. So we've obviously come off substantially only in a very short period of time. But looking forward, again, gold does have the structural demand from central banks. And in turn, it's harder for money managers to stop out of the gold trade. It's harder for retail participants to stop out of the gold trade. The friction that central banks have embedded into the gold market actually fuel market psychology towards accumulation and towards higher and higher prices. So until central banks really take a step back, I think you'll see a lot of analysts continuing to chase the outlook on gold.
Daniel Ghali, got to leave it there, sir. Appreciate your time. Daniel's Director of Commodity Strategy at TD Securities.